We have good trends in earnings in terms of beats, but we all have to remind ourselves these are companies beating estimates that have been lowered and lowered and lowered again, really since the start of this year. It's good enough for short-term sentiment. People hear companies that they're invested in say constructive things. Demand is not falling off a cliff. There aren't any real blow-ups to speak of. There are certainly areas, of concern. You listen to the trucking companies, some of the stuff that they're talking about, they're using the R word in some of their commentary. But, you're just not seeing anything to say that earnings is the concern. The real concern is that we've done a lot in a very short period of time, and we really don't know what the ramifications will be in funding markets, in emerging markets. We don't know what's going to happen with the rapidly increased cost of borrowing and how many blow-ups we'll end up getting. None of that has happened yet. So as much as it's late, maybe potentially halfway through the game or late in the game of the hikes themselves, in terms of the ramifications of all that hiking and tightening, coordinated tightening around the world, we really have no idea what that's going to lead to. I think it's a 2023 story. It is. And that's what keeps a lid on. That's what keeps a lid on whatever optimism you want to have about how close we are to the end of the cycle.
That's why you got to be careful to not read too much into the fact that it's all good now, but it might not be all good then. Shannon,
nothing's happened yet.
Not yet. Not yet. But people are betting on the fact that it's going to eventually happen. And I mean, I've had many conversations over the last handful of days with some pretty big time and smart investors who say, okay, now's now, but eventually it's going to come. It's going to definitely come home to roost. So, Shannon, I'd like your view.
Well, if we're anticipating in 2023 it comes home to roost, shouldn't the Fed be anticipating that as well? I think that's the question that I would pose to Steve and Jim around, these expectations for the Fed, and Josh said it best, I can think a couple of weeks ago, terrible at forecasting where Fed funds are going to be, because we do not know what the ramifications are of the pace of the hikes that we've seen. We also have what's going on behind the scenes, really, and we've lost emphasis on, is balance sheet tightening, quantitative tightening. 6 months ago, Scott, we couldn't talk enough about how the balance sheet was going to be wound down. And I think that is the lever that we're really not talking about in terms of what the Fed could be doing behind the scenes. Even if they do get to 4.5 at the end of this year, that transmission mechanism, they could be, sort of taking that lever down in terms of the balance sheet and providing a little bit of a cushion. I think the other thing that we need to think about is, are we talking about an economic contraction? Are we talking about negative GDP of 1% next year? Or are we talking about a deep and sustained recession? To get a deep and sustained recession, we need to lose 1.5 million jobs this year. I don't know about you, but when I talk to companies in the real world, to Jim's point, they're not laying off people. And so I have a hard time seeing the expectation for a deep and sustained recession from late 2023 into mid-2024, because I don't think we're going to lose enough jobs to create that environment.
Yeah. So, Leisman, I mean, they want – you have to be pretty open with what they want, the Fed, right? They want growth to slow. They want spending to slow. They want jobs to slow. They want jobs to slow. They want everything to slow. They're telling you that they're going to do whatever it takes, essentially to make it slow. But people like Jim are still out there having a rosy view. I don't know.
Rosy view. I want to take something that Josh said in a perfectly understandable way and make it less understandable and talk about it in monetary policy terms.
And by the way, I just want to point out the market, too, is you gave us the Harker headlines, which were hawkish. There's no other way to suggest it.
And Harker's a middle-of-the-road guy. Harker's not going to lead the pack. He's going to vote next year. He's not going to lead the pack down, down the hawkish path. He's going to be middle of the road. So a guy like that talking about. I want to emphasize what Josh was saying. And it gets back to the great conversation we had with Professor Siegel a week or so ago, as follows. The Fed says it just became restrictive. So if you think about the idea the Fed just became restrictive, all of the monetary policy up to the point that it became restrictive is prospectively into the future stimulative to the economy. Restrictive and the impact of a restrictive funds rate is what's in our future. And that's when I said, Josh said it perfectly understandably, that's a 2023 story. So I'm saying the impact of a restrictive rate, that explains, by the way, why the Fed felt it had to get to where it was going so quickly. It wanted to get restrictive so that the future that we had was one of restrictive policy. Our survey today, Josh, of the All-America Economic Survey, finds that 43% are affected by higher interest rates. That number is going to get higher, and that's going to slow stuff down in the future.